Imagine your boss calls you into the office on a Friday afternoon. You've done stellar work this past year, you hit all your targets, and they are handing you a 10,000-pound bonus.
Right. The dream scenario.
Exactly. You are thrilled. But what if I told you that because of a, well, like a hidden glitch in the tax matrix,
Huh.
the government is legally going to keep 6,000 of it?
Oh, man.
Yeah. You do the hard work, but you only take home 4 grand. So today, we're taking a deep dive into the invisible traps that are, secretly destroying your wealth. And more importantly, the structural strategies you can use to actually protect it.
It's a really harsh reality to wake up to. I mean, when people think about getting wealthy, they totally obsess over top-line income. They think, oh, if they just earn more, the wealth just automatically follows, right?
Right.
But the sources we're unpacking today, they prove that wealth accumulation is actually a game fought on, well, two incredibly complex battlefronts.
And we have a really fascinating stack of sources to guide you through this today. We're pulling from a deep psychological analysis of lifestyle inflation that one was published by CalScope in India.
That's a great one.
Yeah, it's eye-opening. And then we're breaking down the incredibly dense, almost hidden mechanics of the 2026 and 27 UK tax system using briefings from Tax Radar, the M Group, and RSM UK.
Super dense, but we'll get through it.
We will. And finally, we're looking at a highly strategic rulebook for Century investment bonds out of Australia to show you how structural sanctuaries actually work.
The whole goal here is synthesis. We want to help you understand how to plug the psychological leaks in your own spending habits, and then once you start accumulating cash, how to actually navigate the complex mathematical realities of the tax system so you get to keep it.
So let's start with that first battlefront, right? The internal one. We've established that you have to cap your own spending to capture wealth. But, I mean, why is that so difficult?
Yeah, it's the classic problem.
Before we even look at the systemic ways the government taxes you, we kind of have to look at the psychological ways you tax yourself, which brings us to lifestyle inflation.
Right, also known as lifestyle creep. This is basically the phenomenon where your spending increases proportionally to your income, or, sometimes it even outpaces your income.
Which is terrifying.
It is, and it's the most insidious wealth killer because it feels completely natural.
CalScope actually breaks down the psychology of this brilliantly.
Mm-hmm.
It all starts with the psychological weight of a raise. You get a promotion, your brain gets this massive dopamine hit, and you feel like you've, made it.
Exactly.
You feel this deep emotional urge to validate your hard work with a reward.
But the danger isn't the celebration itself, right? Like going out for a fancy dinner to celebrate a promotion isn't going to bankrupt you.
Right, a steak dinner is fine.
Yeah. The danger is how that dopamine hit translates into recurring structural expenses. You don't just buy a nice dinner, you convince yourself you deserve a better car, which adds significantly to your monthly loan payment.
Oh, and the insurance goes up too.
Exactly. You move to a more expensive apartment, you upgrade your wardrobe, you fall victim to like subscription creep, where suddenly you have 6 streaming services and a boutique gym membership.
It's almost like a physiological tolerance, right?
Mhm.
Like if you drink 1 cup of coffee every day, eventually you need 2 to feel that same buzz.
That is a highly accurate way to frame it, actually.
With lifestyle creep, your brain builds this status tolerance.
Mhm.
The new luxury car just becomes your new baseline normal. So 3 years from now, only an even more expensive car will trigger that same dopamine hit of feeling successful.
Yeah, and CalScope outlines a really stark reality using Indian rupees as an example. Let's say you secure a salary increase of 5 lakh rupees.
Which is a fantastic raise.
By any metric, yeah. But if your new baseline normal results in 5 lakh rupees of additional annual spending, you've made 0 progress toward financial independence. I mean, your wealth has not grown at all.
You're just moving more water through the pipes, but the reservoir isn't getting any fuller.
That's a great analogy. To help you diagnose this, CalScope uses a lifestyle creep index. It's basically a score from 0 to 100.
Okay, how does that work?
So if you sit in the 0 to 25 range, your expenses are growing much slower than your income. You are objectively building wealth. But if you hit that 56 to 75 range, your expenses are actually growing faster than your income.
Wow.
Yeah, you might be earning a higher salary, but month over month, you're actually getting poorer.
Let's look at the compounding math on this because the divergence over time is staggering. The source maps out a scenario. Say you're earning 12 lakhs a year and you're consistently getting 10% annual raises.
A very solid career path.
Right. But if your expenses also grow at 10%, meaning you suffer from full lifestyle inflation after a decade, you've managed to save some money. Maybe, like 40 lakhs.
But look at what happens if you practice what they call controlled inflation. If you restrict your expense growth to just 5% a year, while your income grows at 10% over that exact same decade, the difference in your invested wealth is a massive 70 lakhs.
70 lakhs. Just by, slowing down the rate of your lifestyle upgrades, you drastically alter your entire financial trajectory.
Absolutely.
But obviously, resisting that dopamine hit requires immense willpower. And willpower fails. So how do we actually implement this?
Well, you remove willpower from the equation entirely.
Okay.
CalScope proposes the 50% automation rule. The moment your salary increases, before that new money ever hits your primary checking account, you just automate 50% of the net increase directly into your investment accounts.
Oh, I love that. So you still get to enjoy half of your raise. You still get a lifestyle upgrade, which, satisfies that psychological need to feel rewarded.
Yeah.
But you guarantee that your wealth-building engine captures the other half.
Right. And they pair that with the 24-hour upgrade rule. You basically mandate a 24-hour waiting period before making any major lifestyle upgrade following a raise.
Just to let the adrenaline wear off.
Exactly. It forces a cooling off period where you have to ask yourself, do I actually need this upgraded car, or is my brain just riding the high of the promotion?
It kind of comes down to untangling visible status from actual wealth, doesn't it? Like, true wealth is often completely invisible. It's sitting quietly in brokerage accounts, compounding over decades. It's not the depreciating asset parked in the driveway for the neighbors to see.
Which is a profound shift in mindset.
Okay, so let's say you do it. You beat your own brain. You implement the automation rule. You build your status tolerance. You aggressively grow your income while capping your expenses. You're doing everything right.
You're winning the internal battle.
Right. But the cruel irony is that the moment you successfully do this, the financial system has built-in tripwires to capture that wealth right back. And the most brutal example of this we found is in the UK.
Yes. This is the external battlefront. And we are looking specifically at the 2026-27 UK tax year, focusing on a phenomenon widely known as the 60% tax trap.
Wait, slow down here, because I'm looking at the official UK tax tables provided in our sources from the M Group and RSM UK. The basic rate is 20%, the higher rate is 40%, and the absolute highest additioning rate for top earners is 45%.
Yep, those are the official brackets.
So where is 60% coming from? Does the government just have a secret tax bracket?
Huh. Well, it's not a stated bracket. It's a mathematical quirk in the system. It's a trap that catches high earners completely off guard because it just isn't listed on standard tax tables.
Okay.
It affects people earning between £100,000 and £125,140. And it all revolves around how the government handles your personal allowance.
Okay, so the personal allowance is the amount of money you are allowed to earn completely tax-free every year, right? Which, for this period, is £12,570.
Correct. For most people, the first $12,570 they earn is completely untaxed. But the government decided that once your adjusted net income crosses $100,000, you're deemed basically too wealthy to need that tax-free allowance.
Oh, I see where this is going.
Yeah, so they start taking it away from you.
But they don't just revoke it all at once when you hit 100,000, right? They taper it.
They do, and the taper is incredibly aggressive. For every £2 you earn over the 100,000 threshold, your personal allowance is reduced by £1.
Let's translate that into actual money hitting a bank account, because this is where the math gets vicious.
Oh, it really does.
Let's go back to our opening scenario. You earn exactly £100,000. Your boss gives you a £10,000 bonus. So you're now earning £110,000. What literally happens to that money?
Let's break it down into two steps. Step 1. You pay the standard 40% income tax on that new £10,000 you just earned. That costs you £4,000.
That makes sense. That's the published bracket.
But here's step 2. Because you earn £10,000 over the threshold, the government applies that lose £1 for every £2 rule. Half of your £10,000 bonus is £5,000.
Okay.
So the government strips away £5,000 of your tax-free personal allowance.
Meaning, £5,000 of your underlying salary, which used to be completely tax-free, is now suddenly dragged into the taxable realm.
Yes. And it gets taxed at your highest marginal rate, which is 40%. So 40% of that newly taxed £5,000 adds another £2,000 to your tax bill.
So wait, if we tally this up,
Yeah.
you pay the £4,000 standard tax on the bonus, plus the £2,000 penalty tax from the lost allowance. The government takes £6,000 in total taxes on a £10,000 raise.
Exactly.
That is an effective marginal rate of 60%.
And this brutal taper continues pound for pound until your income hits £125,140, at which point your £12,570 tax-free allowance is completely mathematically wiped out.
I mean, if I'm a listener caught in this bracket, my immediate reaction is just to turn down the bonus or go to my boss and ask to drop down to 4 days a week. Why would I ever work harder or take on more stress just to get penalized at 60 pence on the pound?
I get it, that emotional reaction makes total sense. But it is mathematically the wrong move. Even though an effective 60% rate feels punitive, you are still keeping 40 pence of every extra pound you earn. Your net wealth is still increasing.
So turning down income is never the answer.
Never. The answer requires strategic navigation, not avoidance.
Which means we need to understand the levers the system gives us. How do we bypass this trap? The sources mention that everything pivots on your adjusted net income. Can you explain, what makes it adjusted?
Sure. So gross income is the total top-line number your employer pays you. Net income is what hits your bank account after taxes. But adjusted net income, or ANI, is the specific number the UK government uses to test your eligibility for allowances and benefits. It's your total taxable income minus specific government-approved deductions.
So if I'm understanding this correctly, if I can legally, artificially depress my adjusted net income so it stays below £100,000, I don't trigger the taper,
Right.
I keep my allowance, and I bypass the 60% trap completely.
That is the entire strategy. And the most powerful tool to adjust that income downward, as highlighted by Tax Radar, is a salary sacrifice pension contribution.
Oh, okay. So instead of taking that £10,000 bonus as cash and getting slaughtered by the 60% tax, I instruct my employer to funnel that £10,000 directly into my pension before it ever hits my paycheck.
You got it.
Because it's a salary sacrifice, the government doesn't count it toward my adjusted net income. My ANI stays at exactly £100,000.
You keep your full personal allowance. You avoid the 60% tax entirely. And think about what that actually means for your wealth accumulation. You just deposited £10,000 into your retirement account.
Yeah.
But because making that deposit saved you £6,000 in taxes you otherwise would have paid, the actual out-of-pocket cost to you was only £4,000.
You are essentially buying £10,000 worth of investments for 40 cents on the dollar. That is a massive structural advantage.
It really is. And as the RSM UK tax facts outline, you have an annual pension allowance of £60,000, meaning you have a tremendous amount of runway to use this specific lever.
And pensions aren't the only tool, right? The sources point out you can use gift aid donations to charity, which effectively extends your basic tax rate band.
Yes.
Or if your income fluctuates, you could ask your employer to defer a bonus payout to a different tax year where your income is lower. Or even if you're enrolled in an existing child care voucher scheme, those contributions drop your ANI as well.
The mention of childcare is critical here because it brings us to a concept the M Group refers to as overlapping cliffs.
Oh boy.
Yeah, the £100,000 tax trap doesn't exist in a vacuum. The UK tax code is rigged with multiple intersecting tripwires.
Right. If you have kids, the stakes get even higher.
Oh, significantly. Consider the high-income child benefit charge. This starts tapering away your child benefits the moment your adjusted net income hits £60,000, and you lose those benefits entirely at £80,000.
And then, if you rely on the government's tax-free childcare scheme, the rules are even harsher. The second your ANI hits £100,000, you lose eligibility entirely.
Completely.
There is no taper. It is a sheer cliff. You earn £1 over the limit, and thousands of pounds in childcare support just vanishes.
This is why forward planning is non-negotiable. You have to model all of these cliffs simultaneously. And crucially, and sources really stress this, you must pull these levers before the tax year ends on April 5th.
Because if you wait,
If you sit down with your accountant in May, after the tax year has closed, it is too late. The trap is already snapped shut. Making a salary sacrifice in February alters your entire financial reality. Waiting until May leaves you with absolutely no options.
okay, so pensions are an incredibly powerful shield against high tax brackets.
Yeah.
But they come with a massive catch, right? Liquidity.
Yeah, that's the trade-off.
Pensions lock your money away in a vault until you reach retirement age. You can't touch it. But what if you want the tax efficiency? But you also want access to your capital to, I don't know, start a business or buy a property or fund a sabbatical before you turn 60.
For that level of structural flexibility, we have to look outside the UK. Our source from Australia details a fascinating financial vehicle called Centuria Investment Bonds, which provide a blueprint for a completely different kind of structural sanctuary.
These bonds are wild to read about because they are a structural hybrid. They're officially categorized as life insurance policies under the Australian Life Insurance Act of 1995, but they're utilized almost exclusively as wealth accumulation accounts.
The insurance wrapper is what gives them their power. Because they sit inside this specific legal structure, the earnings inside the bond are taxed internally at a maximum corporate rate of 30%.
Let me stop you there, because the source notes that the actual tax paid by the fund is often lower than 30% due to something called franking credits. What exactly is a franking credit?
It's a mechanism unique to Australia to prevent double taxation.
Okay.
If an Australian company makes a profit, it pays a 30% corporate tax to the government. If it then pays the remaining profit out to shareholders as a dividend, the government attaches a franking credit, which is essentially a receipt proving the tax was already paid.
Oh, that's clever.
Right. When the Centuria bond receives that dividend, it uses that credit to offset its own tax bill.
So the fund is paying far less than 30% internally. But even if it was a flat 30%, if you're a high earner in Australia sitting on a top marginal tax rate of 45%, capping the tax drag on your investments at 30% is a massive mathematical win. Your money compounds significantly faster.
But the internal tax rate is just the foundation. The true magic of this structure is governed by what's known as the 10-year rule.
This is where it becomes a financial time capsule. Yeah. If you hold the investment bond for 10 years or more, all withdrawals of your earnings are completely tax-free in your hands. You don't declare it on your personal tax return. You don't pay capital gains. It is completely shielded.
And importantly, it's still accessible before that decade is up. If you suffer an emergency and need to break the glass in year 5, you aren't completely penalized. You still receive a 30% tax rebate to offset the tax Centuria has already paid internally on your behalf.
Now, if I'm listening to this, I'm trying to find the cash. Do I just have to, deposit a single lump sum on day one, and then I'm forbidden from adding to it for a decade?
Yeah.
Because that isn't very useful for someone trying to invest a portion of their salary every month.
You can continuously add to it, but you have to follow the 125% rule, which is just a brilliant piece of regulatory design.
Let me see if I have the mechanics of this right. The 125% rule dictates that every year you can contribute up to 125% of whatever your total contributions were in the prior year.
Yeah.
And as long as you stay under that limit, every new dollar you add piggybacks on the original 10-year timeline.
You have the mechanics perfectly.
But why 125%? Why do the regulators build it that way?
To prevent tax evasion.
Ah.
Without that rule, you could open an account with $10, wait 9 years, and then dump $2 million into the bond right before the 10-year clock expires, instantly laundering it into a tax-free status.
That makes total sense.
The 125% rule forces a steady, proportional build. It rewards consistent, long-term investors rather than opportunistic tax evaders.
So practically speaking, if I invest $10,000 in year 1, the limit for year 2 is $12,500. If I max that out, my limit for year 3 becomes over $15,000. I can scale my investments up as my salary grows, and when year 10 finally hits, the entire compounded balance becomes accessible, completely tax-free.
It is a phenomenal wealth accelerator, and Centuria has built highly specialized applications for this framework. For instance, they offer an education bond.
Right, where you can nominate up to 10 students, kids, grandkids, or even yourself, and contribute up to $1.25 million per student.
And if you withdraw from the earnings of that specific bond to pay for approved education expenses, you get an additional 30% education tax benefit back.
Wow.
It is unparalleled for intergenerational wealth planning. Furthermore, because these accounts are technically life insurance policies, they completely bypass probate upon the death of the life insured.
And for anyone who hasn't had to deal with an estate, probate is the legal process of validating a will and distributing assets. It is notoriously slow, taking months or even years, and it's public, meaning anyone can see your assets, and lawyers take a hefty cut.
Exactly. But with a Centuria bond, the money pays out directly to the nominated beneficiaries, entirely tax-free in a matter of weeks. No lawyers, no courts, completely private.
So when we zoom out and look at who this is actually for, this is the ideal vehicle for someone who has already maxed out their traditional retirement accounts, like superannuation in Australia, and wants a flexible alternative to setting up a highly complex, expensive family trust.
Spot on.
It allows you to build significant wealth outside of traditional managed funds where you are penalized at your highest marginal rate every single year.
It represents a totally different way of playing the game. It proves that the rules of wealth accumulation change depending on what structural tools you understand how to use.
Which brings us to the core lesson of this deep dive. To truly build and preserve wealth, you have to fight a war on two fronts simultaneously.
You have the internal battle and the external battle.
The internal battle is the fight against your own psychology. You have to actively combat lifestyle creep. You have to build your status tolerance and use tools like the 50% automation rule to ensure that as your income grows, your wealth actually grows with it. You basically have to fix the psychological leak in your financial plumbing.
And then you must fight the external battle against systemic rules. You have to realize that your gross salary is largely an illusion. You need to map out your adjusted net income to avoid falling into hidden marginal tax traps like the 60% cliff in the UK.
Right.
You have to strategically deploy salary sacrifices and look for structural sanctuaries like 10-year investment bonds that legally shield your compounding growth from high tax environments.
Today, we talked about the 24-hour rule to avoid impulsive lifestyle upgrades and the 10-year rule to unlock tax-free wealth in investment bonds. The underlying theme across all of these global strategies is time. It seems the ultimate currency in wealth building isn't actually money. Wait, no, it's not money, it's patience.
Yeah.
What could you achieve if you stopped viewing your financial decisions in terms of what they cost today and started viewing them by the timelines they unlock for your future?